part. We now move to the debate on Part 4, debate on clauses 87 to 93. The question is that Part 4 stand part. Stuart Nash.
Thank you very much, Mr Chair. I'm delighted to say that I think this is the only part of this tax bill, Mr Chair, that is not subject to any amendments through the SOP that was tabled on Wednesday, or was it Tuesday, that was tabled this week. It involves amendments to the Income Tax Act 2004, and I must admit I think every member knows that the Income Tax Act has taken a bit of a hammering under this term. What this part does not do is it does not give a $1,000 tax cut to someone who's earning $1 million and very little to those on the median wage, but what it does do, for example, is it talks about the PI credit impairment provisions, as has been talked about before, but which is also covered by this bill. As this bill adds new sections HM35B and HL19B to the Income Tax Act, and also HL19B to the Income Tax Act, which is the one I'm just going to talk a little bit about. The reason why these changes have been made is because it will clarify that multi-rate PIs can claim deductions for expenses and pay tax for income at the point that they are reflected in the PI's unit price or its financial statements. Even if this is before the PI has legally incurred or derived any the expenditure or income. The purpose of this ruling, this timing rule, is to maintain investor equity over the time by ensuring that investors exiting a PI are attributed their local share of PI's tax. Now, the PI changes, or the changes to the Income Act with regard to PIs, were debated in the Select Committee, and it is one of the advantages of taking these sorts of bills to Select Committee, Mr Chair, because it gives us the ability to question officials, to question our tax advisors, and to question submitters on the changes and how these changes may impact upon their business. And Mr Chair, there were quite a number of submitters that wanted to make representations to the committee about the PI provisions here, and I must admit our technical advisor, our tax expert, did a very good job, Ms Turner, in providing the committee with a sort of a non-technical laypersons. Can you say layman's these days? We've got to be laypersons. Okay.
If I were you, I would use the word layman.
laypersons' perspective and view of what the PI requirements or the PI changes actually involved. And under the new timing rule, for example, Mr Chair, what I will do is outline these a little bit because they are quite important, and they make up by far the largest section of Part 4 of the amendments to the Income Tax Act in this bill. The new timing rule, under the new timing rule, any future change or expense or income that has already been deducted or taxed will also be picked up for tax purposes at the point when the change is reflected in the PI's unit price or financial statements. And there are, there's quite a chunk here which determines future amounts, and this is part clause 2. For purposes of determining an amount for a portfolio allocation period under section HL 19.3, a portfolio tax rate entity may take into account of an amount of future income or future expense or loss. That is, for future income, an amount that, when derived, would be classed accessible income under section HL 19.4a. And as mentioned, Mr Chair, what this does is this actually brings PIs into a lower, it provides a high degree of equity across investment classes, and that's the sort of thing that we want to see. As mentioned, we can't actually go with this bill because there's just been so much change and so many changes that haven't gone before a select committee that makes it very, very difficult to actually have a good debate, a robust debate around the changes when they haven't been consulted for with ordinary New Zealanders. The other thing that this does is these new sections that I talked about in the Income Tax Act ensure that multi-rate PIs are able to claim deductions for credit impairment provisions when they are reflected in the PI's unit price or its financial statements. Credit impairment provisions are created to reflect the decline in the financial assets due to past events. And the reason why this is necessary, I mean, it's reasonably obvious, Mr Chair, but the reason why this is necessary is because there are a lot of portfolio investment entities that have suffered substantial losses due to the current financial crisis that the world is experiencing and has been experiencing for a number of years, for a couple of years. And as a consequence, there needs to be a way to reflect this in legislation. as there is in other parts of legislation. That is why, you're talking about Clause 91 here, sir. This is why these amendments are necessary, and I think you would even agree, sir, that investor equity is, Mr. Chair.
Stuart Nash.
Thank you. The investor equity is it's a very admirable goal for any tax legislation. Now, under this legislation, sir, a PI will only able to claim deductions for credit impairment provisions if it has objective evidence of a loss of an asset's value because of the events that have already occurred. Now, I'm not too sure what objective evidence is. I assume what the managers of the PI can do is they can go out, they can look at stock markets, they can analyse data, they can talk to a whole range of people on the NZX and overseas, depending on where they have actually invested this, and they can get evidence, they can gather evidence, quantitative evidence and qualitative evidence, that in fact there has been a loss. And these amendments, they do apply retrospectively from 1st of October 2007, and as the Chair will be well aware, and as members will be well aware, it is very rare that tax legislation actually is allowed to apply retrospectively. And I would like to just digress ever so slightly. There was a piece of retrospective legislation in this bill, Mr. Chair, which as a committee we discussed at great length around whether this tax bill should contain retrospective legislation. And we actually came to the conclusion, after much debate, which Sir Roger had a very active part in. For those who don't believe when they sit there that Sir Roger is still alive, he took an active part in this debate, but as did my colleague Mr Burns and Mr Cunliffe. And in the end we made the conclusion, because this was quite a contentious bit of legislation in the Taxation, GST and Remedial Matters Bill, we decided that in fact it was in the best interest of all taxpayers if the courts made a ruling around retrospective legislation that was contentious, which we think was probably the right outcome here. And as a consequence of that, as a consequence of going through the select committee process, was withdrawn. Back to this bill, Mr Chair, this is retrospective. However, the bill includes transitional measures to confirm the tax positions already taken by multi-rate PIs on the timing of income and expenses, as well as credit impairment provisions. And these transitional measures prevent PIs from making retrospective adjustments to the tax return following these clarifications. And by that I mean, Mr Chair, is we don't want to have PIs, we don't want to have any sort of legal entity that has already made a representation to the ID, had a ruling on it, provided their tax returns, then coming back and saying, oh, goodness me, with this new legislation we can claw back a whole lot of money. Because it actually works both ways. PIs themselves wouldn't want to be taxed at a greater rate, which they wouldn't do if we're talking about losses anyway. But it's a good piece of legislation. It's just a pity that the rest of the bill hasn't gone well. The rest of the SOP hasn't gone to select committee, because we could have amended that as we amended the legislation through expert advice and liaison with the IRD officials. Now, what do we talk about when we mean reasonable estimation, Mr Chair? Well, if you look at, again, Clause 91, Part 3, it talks about reasonable estimation, and for purposes, it says here, for purposes of subsection 2, the entity must make a reasonable estimate of the amount and must be able to demonstrate, if required, the reasonableness of the estimation by explaining why and when the income is likely to be derived or the expenses are likely to be incurred as applicable, and providing the calculation method and actual calculations used to determine the amount with details showing why the method is appropriate. So again, what this says, Mr Chair, is a PI manager or whoever's looking after the PI can't just turn up to the IRD and say, we believe that we have incurred losses outside of this and we'd like to make representation. What they have got to do is they have actually got to have the evidence in front of them. It's got to be very transparent, which which all tax legislation should be very transparent, Mr Chair. And again, I come back, this is why we are so against this piece of legislation, because there's no transparency, because Labor members of Parliament have not had the ability to actually interrogate this piece of legislation and talk to our officials or the ID officials about it. But this does provide a level of transparency, which is most important, and it's welcome. It's good. I'm pleased it's in here. There is something right in here. And we talk about credit impairment provisions as well, Mr Chair. We go down to we're on 91. This is Part 4, and as mentioned, these are amendments to the Income Tax Act 2004, new section HL 19B. talking about Part 4, credit impairment provisions.